I would like to have the honor of introducing our resource person, Mr. Mohan Kumar, to you all. He is a strategic finance consultant, and he started this after retiring from the bank as a senior manager from the State Bank of India. The most surprising thing is Mr. Mohan Kumar is a marine biologist. And he was doing his doctorate when, due to external circumstances, he had to drop it and become a probationary officer in State Bank of India. And he took to finance the way a fish takes to water. He really grew in his career, and with 20 years of background, he became an analyst of the balance sheets and assessment of credit needs for corporates, giant corporates, while keeping a constant vigil on their financial health. He has completed his CAIIB, then an MBA in finance from Osmania University with distinction. And he was also the branch manager for developing village and introducing DWACRA loans. He was adjudged the chairman club member in the year 2000. The accolades go on and on and on. In short, we can't find a better person to talk about finance for the non-finance people than Mr. Mohan Kumar. Without much ado, I would hand over the platform to him and request him to enlighten us on what are those essential things which, as a non-finance person, we need to know to do business well. Over to you, Mr. Mohan Kumar.
Thank you, Arun, sir, for great introduction. Good evening, ladies and gentlemen. It is an honor to have this opportunity to address such a distinguished audience. Today, I would like to give you an overview of finance. My talk is particularly relevant to those from non-finance backgrounds.
Mohan said, your voice is not very audible. Can you just hold up the mic a bit?
Yes, yes. Is it okay, sir, now?
Yes, it's okay now. Thank you.
I'll just put a slide also. Yes. Good evening, ladies and gentlemen. It is an honor to have an opportunity to address such a distinguished audience. I think now I am audible to you. Today,
you're audible, but your screen is not shared. The slide is not visible.
Okay. Yes. Just.
Yes, you are audible.
Now screen is coming now.
No, screen is not visible.
Oh,
share the screen.
Okay.
Yes, now the screen is visible.
Yes. Yeah. Today, I would like to give you an overview of finance. My talk is particularly relevant to those in non-finance background. It helps them to acquire additional competencies to support their organizational growth. What is finance? Finance is the process of raising funds or capital for any kind of expenditure. Not only that, it should be used in a productive way. Importance of finance. Finance helps us to make better decisions with our money. It strengthens the business to take risk and grow. Corporate finance, basic areas of the finance, corporate finance, personal finance, and public finance. Corporate finance refers to the financial activities related to running a business or a company, whereas a personal finance involves money matters for individuals and their family. Similarly, if you take the public finance, it is the revenue and expenditure of the government. Today, we are discussing about the corporate finance. The principles of business, the main principle of business is creation of wealth. It is creation of wealth not only to the promoters, which in turn leads to the economic development of the nation. That is wealth creation. Not only wealth creation, there is a most important ethical way of doing business. What is ethical way of doing business? Developing ethical standards, aware of enforcing policies, praise positive behavior, promoting community involvement and development. The third and most important other principle of business is follow the laws of land. Following laws of land means all laws that are in force within the country, both statutory laws enacted with the statutory authorities and case-made laws developed with the judicial decisions. Then only one can enjoy the business and it will have a long term. Why does a business need finance? Finance is the lifeblood of a business organization. It is the function within the business that is responsible for overseeing acquired funds, managing existing funds, and preparing for future expenditure of the funds. First, these are actually broadly for starting a new business or a takeover, purchasing a land, plant and machinery, or to replace a machinery, to meet everyday bill payments, wages, salaries, etc., for internal growth and for expansion. The benefits of finance in a business organization, it boosts the sales by giving some credit period to the for repayments, increases the average order value, improve cash flows, attract new customers, and repeat orders from the existing customers. Different sources of finance have different implications for a business. There are major financing decisions. So it is important that the most appropriate method of finance is chosen for the purpose. The first one is source of finance, external source and internal source. External source taken from outside the business and internal source means generated internally. The second one, the proportion of equity capital and debt capital. Debt to equity ratio should be 1 to 1.5. That is, for 1% of equity, the debt should be 1 to 1.5%. It depends upon the industry. Capital intensive industries like financing industries and the manufacturing industries have higher debt equity in general, where ratios are always preferred. Then comes the next one, term of financial source. Terms is either long-term or short-term. Long-term source, which is repayable for more than 1 year. And the short-term source is repayable within a short term, less than 1 year. Now let us discuss each source financing decision, as these are very important business decisions for a managerial level. The source of finance is the external source of finance. External source of finance means provided to the people or institutions outside business, and it creates a debt that will require repayment. Shares, debentures, bonds, loans, and warrants. You may ask, shares is the owner's funds, why it should be repaid? But it is also an entity, business entity. it is a separate entity from the promoters. Shares is the owner's funds, is also repayable at the time of winding up the business. In case of debentures and bonds, these are also repayable and having interest as per agreed terms at the time of issue. And the loans and overdrafts are also source of finance available from banks and financial institutions, repayable over a period by having interest burden. The second source of finance is internal source of finance. Internal source, which is raised internally and it does not increase the debt of the business. And first one is the retained profits. Retained profits is there is no interest is paid, which was generated in the business over a period. Retained profits along with equity capital from the promoters, it forms the tangible net worth of the company. Further, sale of unwanted assets. Once the asset is not required, it is better to dispose of and bring back those funds into the operation to have better cash flows. Similarly, the sale and leaseback. Suppose some of the industries, they will purchase assets initially, but it is required at a different periods. In such situations, it better you sell it and take it on lease, and the lease rentals taking payable to the balance sheet is always comfortable. It gives a comfortable balance, cash balance. It creates an internal source to the business. The next financial decision, important one, is proportion of equity into debt capital. Different sources of finance have different implications for a business. So it is important that the most appropriate instrument of finance is chosen for the purpose. Shares and preferential shares. Shares or preferential shares are broadly promoter stocks. In both cases, dividend is payable as a part of profit sharing. Preference shares have priority over equity shares in getting the dividend and receive uninterrupted flow of dividends, but no voting rights. Whereas in case of debentures and bonds are interest bearing and are payable over a period as per agreed terms at the time of issue of such instruments. Next comes the debt capital. Secure debt from the banks and financial institutions. Debt capital is raised from banks and financial institutions. It is repaid over a period of time and are interest bearing as per sanctioned terms. How much equity should be there and how to the comparing to the debt? That is called the debt equity ratio. It is preferably is 1 to 1.5. That is good. It depends upon the industry. In general, lower ratio is preferred. Where ratio is higher, majority of assets are financed through debt, and the company may have volatile earnings due to additional interest expenses, and it is lower debt equity ratio indicates that the company primarily relies on wholly owned funds to leverage its finances. The third financial decision, which is another one, is also very important. Term of financial source. It is short-term or long-term. Long-term source are shares, debentures, bonds, term loans from the banks and financial institutions, hire purchase and lease. Long-term sources are those which are repayable period more than 1 year. And long-term sources are used for long-term uses like purchase of machinery, equipment, building, or to replace the existing one or to expand the capacities. Shares, debentures, bonds, term loans from the banks are of long-term nature. And another one is hire purchase. Hire purchase means paying down payment and the balance afterwards in installments. This one eases, and this one along with the lease. These also payable on the lease rentals. It eases the cash flows. Short-term finance. Short-term sources are which are repayable within a year, and it is used for a daily day-to-day operations of the company, like working capital loan to purchase raw materials, consumables, payment of wages, salaries, and there is a trade finance, trade credit. It is available now paid, that is buy now, pay later. It is available for purchases, which is interest free, and it is for few days like 30 days, 60 days, 90 days. And then the last one is the factoring. Factoring is a discounting of bills for better management of cash flows. And international factoring is called the forfeiting. And the last one is the overdraft. Overdraft is a temporary facility for a short term available from the banks to meet the mismatch of the cash flows. Earlier, getting an overdraft depends upon the long-term relationship with the banks or ability of the managers in assessing the risk, both to the company as well as to the banks. Nowadays, banks are sanctioning, at the time of sanctioning working capital itself, a small amount to meet shortfalls in cash flows. In order to understand the importance of terms of source, one should understand cash flow. Cash flow management. Any business needs sufficient inflow of cash to finance, to meet its day-to-day outflows. Let us see bathtub. There is inflow should be more, always more than outflow, otherwise it will be dry. Or at least it should match to have sufficient cash flows. In the cash flows, what is this? Is the cash flow. Matching of source of finance and its uses. Long-term source is used for long-term use, and similarly, short-term source to short-term use. In case a short-term finance is used for long-term use, it is difficult to generate funds for repayment, and it leads to cash flow mismatch, and it is very risky. Low cash flows is risky, leads to default of its obligations, and higher level of cash flows indicates inefficient use of funds. It leads to lower profitability. Then working capital cycle. Working capital cycle is a short-term source to meet day-to-day operations of the company. For better management of cash flows, one should understand working capital cycle. In a working capital cycle, there is receivables. Let us say we are recording bills for receipt from our receivables in 30 days, and inventory. And inventory, it includes the raw material, work in process, finished goods, consumables, and their level is 30 days. And payables on purchases are 30 days. So overall, the working capital days is 30 plus 30 minus 30 is 30 days. Larger the number of days, the more cash that is tied up financing the company's operations. For better inflows, improve the recovery of receivables. For maintaining possible low level of inventory and work in process. Further, try to get more number of days of trade credit to have a low or better working capital cycle. For better cash flow, management always monitor movement of this working capital cycle. Then only one should come out of stress. So these cash flows, let us see how many cash flows are there. There are different types of cash flows. Cash, the first one is cash flow from the operating activities. It is operating at less amount spent on the operating activities. Cash flow from operating activities, less amount spent on operating activities is the cash flow from the operating activities. The second one is cash flow from the financing activities. Cash flow from financing activities are funding from companies' owners, investors, creditors, either in the form of debt or equity. And that's the third one is the cash flow from the investing activities. Cash flow from investing activities means funds spent on fixed assets and financial instruments. The net of is the cash available to the business. Let us discuss common finance terms we can notice in financial statements, which are helpful at a managerial level as a part of MIS. And let us discuss in detail. One is revenue versus sales, cost of goods sold, operating expenses, capital expenses, depreciation. Now let us discuss in detail one by one. Revenue versus income. Revenue is the total amount of income generated by the sale of goods or services. Services means a dividend, rent, etc. And is also called top line as it sits at the top of the income statement. Revenue versus sales. Now income is a net income. It is a called the net profit or net income is the company's total earnings are approved at our profit, also known as the bottom line. It is at the bottom of the income statement. Now the sales. Sales is the sale of goods in the revenue, excluding other income, like from services and it is sales. So revenue is a part of, sales is a part of revenue, and including plus income from the services, it gives the total revenue. Cost of goods sold. Cost of goods sold refers to the direct cost of producing the goods sold by the company. This amount includes cost of materials and labor directly used to create the goods. It excludes indirect expenses such as distribution costs and the sales force costs. Just as the formula is starting inventory in a period plus purchases during that period minus ending inventory is the cost of goods. The next item is OPEX, operating expenses. Operating expense is an expense required for the day-to-day functioning of a business, also known as selling, general and administrative expense. It includes rent, utilities, marketing, and advertising, sales, and accounting, management, and administrative services. All comes under operating expenses. Then comes the capital expense. Capital expense is an expense for procuring plant and machinery to get a benefit in the future or over a period. The next one is the depreciation. Is an accounting method of allocating the cost of asset over its useful life or life expectancy. It represents how much of an asset's value has been used up for producing the product during that period. The most important ratios one should observe is profitability ratios. Gross profit. It refers to when a company's profit and after subtracting the cost of producing and distributing its products. The second one is the net profit. It indicates a company's profit after all of its expenses have been deducted from the business. And the most important one is EBITDA. It is earning before interest, tax, depreciation, and amortization. EBITDA can be used to analyze and compare profitability among companies and industries as it eliminates the effects of financing and capital expenditures. Finance means not only financial management, it is having financial accounting and management accounting. What is financial accounting? Financial accounting is a specific branch of accounting involving process of recording, summarizing, and reporting n number of transactions in the business over a period of time. This involves preparation of financial statements. It is an information to the external parties like shareholders and creditors. Financial management is a business function that deals with investing the available financial resources in a way that greater business success and ROI, return on investment, is achieved. It involves organizing, planning, monitoring, and also controlling the financial resources. Management accounting is the third one, also known as cost accounting. Is concerned with the identification, measurement, analysis, and interpretation of accounting information so that it can be used to help managers to take informed operational decisions. It is a process of analyzing the business costs and operations to prepare internal financial records for the business to take the decisions. Let us discuss overview of the costs, because now I had given you the cost accountancy, costs associated with the business to have a better control of the costs. Types of costs. Direct costs. Direct costs are related to producing the goods and services like raw materials, labor, expenses, or distribution costs. Costs of packing, shipping associated with producing the product. The next comes the indirect cost. Indirect costs are expenses unrelated to producing a goods or service. A good or service. Indirect costs cannot be easily traced to a product. It includes overhead costs, administrative costs, etc. The third one is the fixed costs. Fixed costs are those which do not vary with the number of goods or services over a short term. Let us suppose we are taking a machine on lease. The lease rental pay will remain unchanged and not depend upon the number of products we produced. The next cost, important cost, is variable cost. It fluctuates as the level of production output changes, contrary to the fixed cost. Example, raw material, packaging cost, etc. will be fluctuate. That's why it is called variable cost. Next one is operating cost. Operating costs are expenses associated with the day-to-day business activities, but are not traced back to one product. It can be variable cost or a fixed cost. These are important costs. It is an overview because it is a very complicated and specialized subject. Just I'm giving an overview of it for a managerial level to understand the costs. Any business starts with an intention to generate profits, so that one should understand from which point of production or activity their business and make profits. To understand this, one should understand about contribution margin. What is contribution? It is the product price minus variable cost and minus all associated variable cost. It resulting in incremental profit earned for each unit sold. And what is the break-even point? Break-even, abbreviated PE, normally in short term. It is a point of balance, making it neither a profit nor a loss. Any number below the break-even point constitutes a loss, while any number above it shows the profit. The total contribution margin generated by an entity represents the total earnings available to pay for fixed assets, expenses, and to generate profit. Let us work out an example for break-even point to understand clearly. XYZ company, it sells drum sets to high schools. It sold 1 million of drum sets that had a related variable cost of 400,000 and XYZ having 660,000 of fixed costs during the period, it resulting in a loss of 60,000. That is how revenue is 1 million, variable expenses 400,000, contribution margin is 600,000, it is a 60%. Fixed expenses are 660, there is a loss of 60,000. XYZ's contribution margin is 60%. So to break even, it needs to either reduce its fixed costs expenses by 60,000 or increase its sales by 100,000. It is because calculated as 60,000 loss divided by 60% contribution margin. Another example how to calculate the break-even points in units, because now we discussed about break-even points in amount. Now it is units. This is a Kohli soda is a soft drink manufacturer, decides to calculate the break-even point. His accounting costs are fixed cost 2,000 total for the month. Variable cost is 0.4 rupee per can. Sales price is 1.5 rupee per can. Now, fixed cost, the formula is fixed cost divided by the sales price per unit minus variable cost per unit. It comes to 1,818 units. That shows a Kohli soda needs to sell just over 1,000 cans of soda in a month to reach the break-even point. To monitor financial health of a business, one needs to monitor liquidity and the solvency issues. Then only you can understand the financial health of the business. Liquidity and financial. Liquidity is the company's ability to pay debt obligations and its margin of safety. The first one is the current ratio. Current ratio is the very simplest liquidity ratio by dividing the current assets by current liabilities, which are available in the balance sheet. And the second liquidity ratio is the quick ratio. It is a stricter test of liquidity. In this, more liquid assets like cash, marketable securities, and the receivables are considered, leaves out inventory and prepaid expenses, which are less liquid in nature. Solvency measures the company's ability to meet its long-term debt obligations. The first one is the gearing. Gearing is nothing but debt equity, we already discussed. It is calculated by dividing the debt by the shareholders' funds equity. The second solvency ratio is interest coverage. It measures how many times a company can cover its interest payments with its available earnings. It measures the margin of safety the company has for paying interest on its debt. Now there are costing or management accounting is a specialized subject. Let us have an overview of the important costing methods. The first one is standard costing. Standard costing is the practice of substituting an expected cost for an actual cost. Later, variance will be noticed and adjusted. The next comes the marginal costing. Marginal costing refers to increase or decrease in the cost of producing one more unit or serving one more customer. It is called incremental cost or marginal cost. The third one is the job costing. Job costing, it is a cost assigned to a specific job or assignment. Similarly, there is a contract costing. Contract costing is a normally in case of construction contracts, cost of specific contract with a specific customer, and it is for long term, unlike job costing. Job costing and contract costing are more related. Next costing is a batch costing. Batch costing in case of production processes that are continuous and occurs in batches. Batches are for a specific quantity or a predetermined order. Operational costing prevalent in service sector to calculate cost of a particular service provided to any customer, and it is almost similar to all customers. Process costing. Process costing is a cost of each process. It is divided by the number of units produced in that process. That gives the process costing. And the last one is the composite costing. Composite costing is calculated by multiplying the cost of each capital component by its proportional weight. In a business, one should be conscious of its cash flows and periodically observe the movements of profitability, liquidity, and a solvency ratio, and adheres to better appropriate pricing policy, then only it can achieve its goal. Thank you.
Thank you, Mr. Mohan Kumar, for a wonderful presentation on finance. I'm sure most of us are that much more aware of the importance of finance. Let us open the platform for a few questions. We got around 15 minutes.
Okay, sir.
Any questions?
Sir, I have a question.
Yes, please.
Mr. Mohan Kumar, you were explaining something about operational cash flow. In one of your slides, you explained about operational cash flow.
Yes, yes.
Can you just let me know more about it?
Yeah, it is operation. It is the cash flow generated from the operation minus expenses utilized. That is the net of the operational cash flows. Is the operational cash flows. It is the main source of a cash flow available in the business.
Okay, sir. Thank you.
I might assume, Mr. Mohan Kumar, what you're telling is that cash flow being of three different types: investment, financial, and the regular cash flow. The regular cash flow, which is used for running the
That is the
day-to-day, is
operational cash. Operation
Thank
cash.
you. Thank you. Thank you.
One question I have, Mr. Mohan, Ramarao here.
Please, sir.
We talked about interest coverage ratio.
Yes.
It is applicable only when some loan is taken by the company. Is it okay?
Yes, you are right.
So if a company has no loan on its books, so what will be the interest coverage ratio? It goes to infinity.
Nothing. Infinity, yes.
Okay, thank you.
Mr. Mohan Kumar, what is the healthy interest coverage ratio? Because you see, if there is no loan taken by the company to do its business, it means the utilization of finance is not being done correctly.
Yes, you are right.
Isn't it?
Yes, you are perfect.
So what should be the ideal interest coverage ratio?
It should be more than one, sir.
Huh?
More than one.
Okay. So it should be slightly more than
More
one.
than slightly more than.
Okay, thank you. Can you just lift the voice is dipping again and again. Please don't mind. Yeah.
Yeah.
Yes, Mr. Anil Goswami.
Can I come, sir?
Please
Please,
ask.
sir. Please, sir.
Thank you very much, Mohanji. I have a company.
Sir.
I have a company. I want to close the company now. So all my liabilities are over. So now, what is the process for closing the company? Because I have my own equity in the company. I have no public shares, nothing. All the money, my own equity is there. Say 1 crore rupees, my own.
Okay.
Now, what is the process? How can I close this? What are the statutory requirements? Just briefly.
Yeah. I hope you have repaid all liabilities of the stakeholders, whether it's the banks, financial institutions, your creditors, and your customers. Then only your equity is available. And you have to take the certificate from those people and to file with an ROC for winding up business. Once ROC accepts, because if it is all companies are registered with ROC,
Yes.
And I hope it is not a public limited company and a
No.
listed company. So
It is
you
a-
just file with ROC. Once ROC approves,
The pri-
you can
it is a-
withdraw your.
It is a private limited company. I only have, most of the people, when I interact, they also ask, because there are two people involved. One is company secretary, other is this chartered accountant.
Yes,
And,
yes.
and unless there is a total coordination between these two people,
Yes, you are right.
I
so
don't think
it takes
Mr. Mohan
years
Kumar
and years
is
to
it.
closing. That's the problem.
Yes, sir. Please, sir.
You see, Mr. Anil Goswami ji, it is very simple.
Yes.
At the end of the year, get your books audited.
That is
Take
important.
the audited balance sheet to your company secretary.
Yes.
File with
Tell him
ROC.
to file for closure. You will have to give an affidavit that if at all any demands are made on you at a future day by anybody, you will fulfill the obligation. The matter ends there. I think it's as simple as that. Because as you say, you are the only person who is the equity holder.
Yes.
I presume you, your wife, your son and others, it should be a closely held company. So there's absolutely no issue.
Sir, suppose if earlier balance sheet shows there is a debt from some financial institutions, banks, he has to submit a certificate for
NOC.
NOC.
Normally, chartered accountant says we have 3 years, nil profit and loss account, nil balance sheet. Only then it is very easy to close the company. This is what it happened. And
Yes,
most
sir,
of the people.
Normally, it will not be taken up immediately.
You're
But
right. It
we can withdraw our amount which is available in our current account or fixed deposits. But we can file with ROC. It takes its own time.
I know number of cases they have huge. I know number of cases they have huge balances, crores of rupees in their current account. They are unable to withdraw it because the statutory requirements, even they are spending nothing for last 2, 3, 4 years. They have to get Reserve Bank approval. This.
No Reserve Bank approval, sir. You can withdraw because
there are a lot of things which come on the way. It is very easy to start a company, but very, very difficult to close it. This is what
You're right. You're right, sir.
Yes.
Opening is very
Thank
easy. It can be done within a week.
Yes. What is your
Mohan Kumar, sir, I have one question.
Sir.
Sir, can you explain the relation between bankruptcy and finance?
Bankruptcy.
Yes, and finance. How that?
Good question. Yeah. Finance means taking the finance from the either external or internal. That is the finance that I already explained. Bankruptcy means the default in meeting the obligations, and if they don't have sufficient funds, then it leads to bankruptcy.
Any bankruptcy leads to insufficiency of funds.
Yes. Then banks itself will go for
it is your incapability to pay your liability. You are not capable to pay your liability.
Yes.
You become bankrupt.
Yes.
And sir, what about the GST and income tax closure before closing any GST and the income tax in clearance? These are also required, na?
Yes, because once your balance sheet is completed, you have to file income tax return. By the time I think you have to complete the GST and you have to surrender the GST number also.
Yes.
They will verify your records and they will give letter. Normally it takes some time. And income tax, once you filed, and it will take 3 months, because last 1 year back, I did close one of my company.
Mr. Mohan?
Sir.
Nagi here. Maybe a crazy question. As a private limited company, you have some shareholders.
Yes.
Company not doing good. Okay, the shareholder values gets down. But
please repeat.
Being
it's a private limited company,
the shareholding value because of the operation might have dwindled a lot.
Yes.
But as a goodwill, what is the process of buying back the shares?
By the company?
Yeah.
It's very low rate. because it's already depreciated. No, their share value.
So, yeah. So how do we get to address that?
No, why should a company
Who will
again?
be evaluating it, and the
Actually, it
modus
should-
operandi, the
it
procedural
is-
aspect of
yes,
that
yes,
aspect?
you're right. It should be evaluated with the professionals. There is a professionals like some chartered accountants, financial analysts are there. They will analyze the value of the company and they will attribute some value to the shares if it is a depreciated. And I think, recently we got valuation of LIC and we purchased the shares also. Similarly.
Correct me if I'm wrong, Mr. Mohan Kumar. Normally, every year end when the balance sheet is created and the accounts are audited, the chartered accountant is also supposed to give you the valuation of the shareholding, isn't it?
Yes, definitely,
Yeah.
sir.
So
They
that
have
can be guiding principle.
It is a
if at
guiding
all.
principle. Besides, before going for any such a decision like purchase back the shares, one should take a professional advice also.
Yeah.
Mohan sir.
Yes.
Yeah, I can understand a shareholder transforming in a private limited, a shareholder with a mutual understanding transforming it to another shareholder, fine. But how about company buying it back?
How the company?
Can the company buy it back?
By whom?
Nagi Sahib, your voice is breaking.
Yeah, I'm at a distant place.
Okay.
Maybe I'll put it up on the WhatsApp and then
Yes, you are not audible.
I'll do that. I'll do that. Thanks, sir. Anil Sen. Thank you.
Sorry, thank you. You are not audible.
Yeah, I'm at a distant location. I'll catch up with
Okay.
you on later, Mr. Arun sir. Thank you.
Yes, Mr.
I
Christopher
think-
had a question.
Yeah,
Mr.
yes,
Augustus
yes.
had a question.
At what point does it become sensible to start distributing profits? Normally, distributing profits, it is by way of dividend to the shareholders or preference shareholders. Normally, once cash flows are sufficient to continue the business, then only one can go for the distribution of profits. That is the right way.
Mr. Augustus Selvadura, you had a question?
Yes, sir. So I'm a new entrepreneur. So what is a recommended accounting software which you would, in your experience, you would recommend? That is now my first question. My second question is in terms of reviewing the accounts, what frequency a new entrepreneur should review the accounts? Is it weekly they should review or monthly they should review? What is a good frequency in your experience, sir? Because we're just starting and it is overwhelming as such, to run the business as well as to take care of the accounts. So in your experience, what would be the right things?
You are right. Good question, sir. Actually, a new entrepreneur, better to start weekly review. After some time, once you got a satisfied, and you can increase to monthly or quarterly.
Okay, sir. And what accounting?
So I think we have Tally software.
Tally
which
is
takes
the
account
better.
everything. Yes.
Tally nowadays Tally is improved a lot and it takes care of accounting.
And it is very user friendly.
Very user friendly. That's it.
Okay. Thanks, sir. Thanks, sir.
I have a small question, Mr. Augustus. When you are talking about reviewing, are you talking about maintaining the book of accounts or reviewing the book of accounts that you are maintaining?
Reviewing the book of accounts that we are maintaining, sir.
Manager
Records.
So because
Daily-
many people think that maintaining a book of account is equivalent to reviewing.
That is at lower level.
At the beginning, opening level, maybe you might have outsourced the maintenance of book of accounts to an outsider, and that person will come once in a week and fill up all the data entry and everything. That's why I asked.
That is what Tally does. Sir.
Yes. And the Tally gives the MIS.
That is what Tally does. Maintaining the account. Yes. All taxes, account, everything is done.
Yes.
Mohan Kumar sir, can you just guide how one can measure the finance distress? How is if the company is running the is is not going in bankruptcy also, but is it in distress, and it is not showing to the public that it is in distress. So how one can measure?
One can measure how to come out of it.
One can measure how is their financial position
Will be improved.
because it is not revealing its financial position.
His question is especially for like company like Satyam, they never revealed. Yes. There are certain companies like Satyam, they don't expose themselves. Ultimately, all of a sudden something happens. Hanji Tiwari sir?
Yes, sir, you are right, correctly.
Yes, sir, one example, Big Bazaar has merged in Reliance.
If everyone is going to talk, then I think Mr. Mohan will
I
have.
cannot answer at a time. Yeah.
So you see, what I suggest is let everyone keep quiet, and if you want to add something after Mr. Mohan has spoken, I think that would be better.
Yeah.
Yes, Mr. Mohan, you please handle the questions. Others will maintain their discreet silence.
Okay. So Virendra sir.
Yes, sir.
Can you repeat? Yeah.
Yes, sir. My only thing that the company is what is called it's in a distress, but it is in an opaque condition. Means they are not revealing their financial positions. Okay. But they are in distress. Okay. But how can a general public or a shareholders or investors or in terms of banks who has provided the loan, provided the loan, how can they measure their finance distress or finance distress or their good position or bad position?
Bad position. Yes, you're
in both ways.
Good question, sir. Yeah, first thing, the financial statements itself reveals. Suppose if you want to see the latest financial statements will reveal some information. Normally in banks, we'll take a periodical information from the company and it will be analyzed and we will send a letter when there is any reduction in the revenue or reduction in the profit or there is a reduction in cash flows or there is
sent a letter to the ROC, sir? Registrar
of
company?
No, not immediately, sir. ROC don't have that much time. So first of all, we'll ask the company to reveal it. In case the company is not in a position to answer within 15 days, bank will take action. Yeah. ROC will not come into this picture.
So bank had hand in glove with that concern, then, sir, in that case?
If everybody is in hand in glove with such a person, it is it is a great mess.
Yeah. I understand. I understand that. Yeah.
Virendra ji, we have to go to London. We have to go to London. That's all.
Virendra ji.
Yes,
sir.
Mohan sir.
Virendra
Yes,
sir.
please.
The role of ROC is.
Let us maintain some seriousness. There are people who are asking questions. Please.
Mohan sir.
I am requesting with folded hands. Let's not turn it into a jumbo.
Please, Jefferson.
Hello. Sir, this could you explain? Could you explain about overtrading? I see most of the companies getting into this bankruptcy and the liquidity problem due to overtrading. Could you explain? Could you enlighten us?
Yes. Without having the proper financial arrangement, if somebody taken up more trading, you mean trading means more income or more taking more contracts or executing more contracts or trading in a more number, and they don't have, and there is a problem of receiving the payments that leads to the cash flow mismatch. I think I'll put it in a simple way. When somebody did some over trading, like what you said, and it is not possible to recover all receivables at a time. definitely there will be mismatch in this, and they will default in payment obligations. And not only interest. Nowadays, I think IRAC norms, every bank or even a private institution also need to pay the interest monthly. If there is any 1 month, it leads to some, it is under scanner.
Yeah. Sir, I have another question. Now there is some cost. Then you detail certain cost. There is another cost called sunk cost, where the company are invested in certain asset.
Because the costing itself is a very complicated and a specialized subject. But for a normal entrepreneurs, that's why I had given only overview of the cost, which are normally can be called easily understandable. Thank you.
Can I share some thought in this, Mr. Zafar, Mr. Mohan?
Yes, sir.
Yes, sir.
Mr. Zafar, sunk cost is not in the costing in finance. Sunk cost fallacy is a management behavior where when the money which you have put into a project has gone to waste, it is better not to put more good money after bad money and they bail out. You see, Tata Nano and its Singur project was a classic example of a sunk cost fallacy, and the shifting to Gujarat was the outcome of that. So sunk cost would not come under the costing category in finance. I hope I'm right, Mr. Mohan.
Sir, it is also already, it is also in the costing also, but it is it was discussed just like that.
Okay. Thank you.
Mohan sir, my question is that the Big Bazaar has merged in Reliance.
Okay.
And the outstanding of Big Bazaar, they are denying.
Denying?
They are not replying or not denying on what happened to this situation.
Sir, it is not replying to whom? Creditors, bankers?
Creditors. Just say, suppose myself as 15 lakhs are outstanding in Big Bazaar.
Okay.
And they are not neither reply nor they have merged. We cannot go to Reliance. And Big Bazaar are not listening. What happened in such case?
Oh, you can go for the because as per paper news, as you said, it is merged with Reliance. So it is the obligation on the part of the Reliance to pay service the.
But Reliance are not listening, and Big Bazaar has.
No. Yeah, I can understand. As a common person, we cannot approach a Reliance, and there may not. But NCLT is there. You send a notice through NCLT. You file with NCLT.
So he can go to SEBI, SEBI. He can go to SEBI. They will definitely take action.
SEBI is one, and NCLT, no, it is very drastic on
NCLT.
Yes. If your once notice has gone, now relevance immediately take care.
Okay. NCLT. Well, what is the full NC? What is the full form?
National Company Law Tribunal.
Law Tribunal, yes.
Okay. Thank you.
First, go to SEBI. If they don't listen.
Okay.
Because Reliance is a listed company, that's why better go to SEBI also. But the best way is NCLT. For all companies, NCLT is the notice from NCLT.
Notice from NCLT.
Mohan, thank you very much. Thank you very much.
Thank you very much.
The questions are
even very nice presentation.
Full day you are here. It was not very so nice. Very effective presentation. Very knowledgeable. God bless you. God bless you.
Thank you very much, sir. Thank you.
Thank you.
Sir, it is only because of Arun sir's
yes,
encouragement.
Yes,
anyhow,
Arun,
yes, sir. Thank you all for sparing your valuable time.
He is our mentor, motivator.
Mentor, yeah.
Everything. Everything.
Yes, sir.
Thank you, Mohanji, for the excellent session.
Sir, actually,
we look
I have
forward to many more such sessions
with your
from you.
support only, sir. I did this, and
No,
Definitely, that credit goes to you also, sir. You are a man.
nothing like that.
Great session.
And let me tell you all that this coming Wednesday,
Sir.
process management expert, Mr. Chandrasekhar,
Yes.
who is an MS from BITS Pilani and has got, over 3 decades of experience in process management. He is going to be taking a session for manufacturers on shop floor team building. How to build a team on the shop floor for optimum result. The links have been posted already. Please register. It's a free webinar from 7:30 to 9:30. We look forward to your presence on Wednesday, the 5th of October.
Sure, sir.
Mr. Subramaniam, Arun, and Shyam.
Yes, Mr. Shyam. So very nice of you. You know, we have got a giant here. Yes, can you please unmute Mr. Shyam? No, Mr. Shyam Sundar is a brilliant brain in finance. He's also a strategic financial consultant. I did not know he was there on the platform. Yes, Mr. Shyam, tell me.
Yeah, very much. Wherever you are there, Mr. Subramaniam.
Thank you, thank you.
All right, Mr. Mohan Kumar, it was very informative. I'm
Thank you,
sitting on the other side of the table because I've never been to a bank, right?
Yes, sir.
Purely from the operations of the financial accounting and reporting. I have worked for about 27 years with a US multinational in financial accounting and reporting.
Okay, sir.
So I've come back to India for good, I would say, but I'm still looking for consulting opportunities. So your product knowledge presentation was very informative and useful. What kind of services you offer to people like in business owners and small MSMEs?
So far, I did some contract basis, some advisory service, and some arranging some finance, and the preparation of TPRs, financial projections.
That's fine. Okay. And I think we need to connect back on a one-to-one basis.
Sure, sir. Sure, sir. Definitely.
I will arrange for a meeting between the two of you, Shyam, sir.
Great.
I think definitely that is on the books and it is called for.
Yeah.
Yes.
Sure, and Mohanji, I can tell you, Shyam sir can be a massive connection for you to enter into the world of finance because he is a financial consultant for most top industrialists in Tamil Nadu. As far as I know.
Excellent.
I don't know about other areas.
That's true.
At least in Tamil Nadu, he is a very, very highly rated financial consultant. And people take to his word like gospel truth.
Very good.
Yeah, that's
excellent, sir. Definitely, I will be in touch with you.
Sure, yeah.
I will immediately after this program post your number in his WhatsApp and his number in your WhatsApp. Please connect with each other.
Thank you,
sir. Thank you.
Very good. Thank you. Thank you.
Yes, Nagi sir.
Thank you. Thank you, Shyam sir.
Thank you.
Thanks a lot. Good night. Wonderful time we had. We look forward to more programs from Mohan Kumar sir. And it would be a great honor if Shyam sir would also decide to give some, programs on financial consulting on this platform.
Sure.
Sure, sir. Thank you very much.
Yeah. And next Wednesday, we are meeting Chandru sir on shop floor team building. Good night.
Sure. Good night, sir.
Thank you.
Thank you once again.